Okay, so this is our last class. We're going to go over capital budgeting. The main thing you want to understand with capital budgeting is it kind of brings together everything we've been working on from the very beginning. So what you get is a little bond valuation, you get some equity valuation, you're going to get some cash flow analysis. So everything you've been working on kind of builds up to this because you needed to learn those things in order to effectively um, judge whether a deal or a uh, project is viable. So just to quickly go over it, and before I do that, I want to point this out again. I put it in today's, a couple of housekeeping items. One is we're at the last week, so anything that you have outstanding, please get it in. This is it. I have to start grading strictly after Monday or Sunday night. So you have to get your stuff in if you want it to be graded. It's really important, really imperative. So I can't stress that enough to be done with that. The second thing, just give me a minute, just adjusting the room a little. The second thing is, just if you need any help, let me know. For anything that you're trying to catch up on, or it's hard to extend extra time after this week, but I can help you during the week. Okay, so that's part one. Part two is where do we really stand now? So just to go over, I pulled up some. Oh, the other thing I wanted to go over is that if you go to my, once again, go to my YouTube channel, and I put these videos in the discussion board. Okay. My channels, my playlists, I'm sorry. And go to Finance Academy, and this is all, you can find these links in the shell, but I put it in the discussions. You're going to get 5 parts on capital budgeting techniques, which is what we're going over today. So there's another review of capital budgeting from another text, so it gives you another view, but it's all the same stuff, obviously. And then weighted average cost of capital. So I can't stress this enough, how important it is for you to go back and look at this stuff. Okay, but just to briefly review. Let's briefly review. What is the cost of capital? Because we need to understand what our cost of capital is if we're going to judge a project, right? Because what we're basically doing is we're taking a series of cash flows and we're discounting it back using present value analysis, which is another topic that we covered in the very beginning. So we're taking present value analysis and we're backing into a value today of a project. So long story short, what we want to know is our weighted average cost of capital, which is the percentage of the capital usage that we've used, that we can only finance our company 2 ways, debt or equity. So we have a percentage of debt and a percentage of equity. Well, the percentage of debt is one part of our cost of capital, and the percentage of equity is the other part of the cost of capital. Now, how do we determine it? Well, it's the riskiness of the firm. The more risky our firm, the more variance from our standard deviation of returns, right? The more our returns deviate from the mean. And again, going back to my Finance Academy, you go to my Statistics Academy. We have time value of money here if you want to review that. If you need to go back to the beginning. Beta, from when we talk about capital asset pricing model. And then you're going to get standard deviation. So the more our returns deviate from the mean, the more risky our company is. And it's not because they deviate, it's because our returns are just not steady. So a company that doesn't have steady returns would imply, theoretically, that they don't have a steady business model. And that makes a company more risky, right? So think about Coca-Cola. whether the economy does really well or the economy isn't doing as well. Generally speaking, the Coca-Cola Corporation is going to say they only could sell so much product, right? They're going to sell X amount of product on the way up. They're probably going to sell X amount of product on the way down. And therefore, their earnings are going to be steadier. And that's going to make them a lower risk proposition. And we see that in the required rates of return with the beta of Coca-Cola, which is how we determine the capital asset pricing model. So say, for instance, we call up Yahoo Finance. And we look up Coca-Cola. Remember, if you're still not sure about what I mean by beta, well, then take a look at my video of last week. The beta there is 0.61, which means the variance of Coca-Cola's price versus the market. And this is not a perfect measure of risk, but it's a pretty good one. It's going to look like this. I'm using a yellow. I don't like the yellow, so that doesn't show up well. It's going to look like this, and the market returns are going to look like this. So it's going to have less variance than the market, is the long story short. Less variance than the market. And we should expect that because, again, we're pretty sure that Coca-Cola is not as risky for that reasons. So it's not because the beta is small. The beta is small because Coca-Cola is the less risky stock. But if I look at something like Tesla, and we only have an hour here, so I'm going to go too deep into this. I'm going to get onto the work. Tesla has a beta of 2. So using that same logic, and again, there are other ways to measure return. We've kind of touched upon in this class. But where the market look like this, the returns, right? It's not it's not a steady line. Markets go up and down. Tesla's returns might look like that. It's more risky because they have more issues, and investors are going to treat them as a company with more issues. So going back to this, we got our weighted average cost of capital, and it gives us a view of what our total risk should be. So it's the after-tax cost of debt, which is, how do we find that? Well, the companies that are listed have bonds that trade. So we could just find the yields on the bonds. That's simple enough, or it should be. And again, if you go back to my, I can't stress this enough, there's a video on that. So you can get everything you need from me. Tutorial on finding a corporate bond yield. So if I want to know Coca-Cola's, for instance, bond yield, well, now it's so easy. I mean, back in the day when I was trading and I said like an old man, well, we had to use like systems and we had to buy systems. Today, much easier. You can go to Trace, which is a SEC thing, but we'll go to Coca-Cola bond yields. And see if I can find this. Let's see the easiest way I can find it. Well, they have a lot of bonds here. You go to FINRA. And FINRA may be one spot where you can find bond data. And just go in and click in this is one place. There's a lot of places where you can go, but let's try this one. Also, Morningstar is excellent. And I show Morningstar on my video. Okay, and you just say, I agree to the user agreement that you're not going to hold them. And now you start to see, here's the prices and here's the yields on different maturities of bonds. So say, for instance, a Coca-Cola bond that goes out to 2050 has a 3% yield. It's going to be a low yield because Coca-Cola is a safe company, and they're going to have a lot of debt out there because they're always financing stuff. And you got pages of debt here. So you're really interesting stuff. Okay. So you find the bond yield, and then remember, bonds are deductible. We got into that a little bit this year. Bonds are deductible. Now, that means bonds are, you can deduct them from corporate taxes. Does that mean we always use bonds? Yeah, and theoretically, bonds are always going to be cheaper than equity because you have tax deduction. You don't get that with equity. But there are a lot of trade-offs. More debt you take on, just like a mortgage, even though mortgages are deductible, you don't want to take on too much debt because it has business disruption costs or it has disruption costs. And then on the other hand, if you finance something with equity, the equity holders get a benefit, so they appreciate that. So we found through theory that if I use more debt at a certain point, there's an optimal level of debt where the equity holders are happy and you get the best rate of return, which is your goal. But if I take on too much debt, the equity holders might require higher rates of return because they're worried about your business risks, your debt risks. So you got to kind of find the right balance. And then you get the cost of common stock times the proportion of common stock, and that is going to get you your weighted average cost of capital, which we've gone over. And once I have that, and they throw preferred stock in here too, but once I have those numbers, now I know my capital structure, I know how much debt I'm using, I know how much equity I'm using, and now I have a weighted average cost of capital. I'm not going to get too much deeper into this because we've been covering this. That's generally what a weight looks like in most companies. 40% debt, 60% equity is what you normally see. And once I get that together, now I know my weighted average cost of capital. So for instance, in Coca-Cola's case, and then you do the capital asset pricing model and you get a cost of equity. So in Coca-Cola's case, they have a beta of 0.6 and they have debt of, say, 3%. And the risk-free rate is 2.5%. Again, if this doesn't make sense to you, well, then I urge you to go back and watch my piece on capital asset pricing model. And so we got a beta of 0.6 with the risk-free rate of 2.5, and we got a market rate of return, which is we went over this last week too, which is the return on the S&P 500, which is the price earnings ratio of the S&P 500. So basically, if you bought all the stocks in the S&P, your general rate of return should be about 5.5%. These are somewhat accurate numbers. I wouldn't take them to the bank, but they're relatively accurate. So the market's going to give you about a 5.5% rate of return. If you bought all the stocks in the S&P and did the beta or the capital asset pricing model for all the stocks in the S&P, you're going to get a return of around 5.5%. Or if you did the price earnings ratio of the S&P and divide it by 1, you're going to get a return that looks something like that, like 20, 21, 22 times price earnings. Right now, it might be a little higher. The market's a little more valued. So let's take it down to 5%. Let's say at least 20 times. It might be a little higher than that, but I think looking forward, 5 is fair because that market's changing constantly. Remember, one thing about betas and price earnings ratios and risk-free rates, they change constantly. So I'm comfortable with these numbers. And if I assume that Coca-Cola is about 35% debt and 65% equity, because that has to equal 1, well, then let's do the math on Coca-Cola. So I have a bond yield of 3%. Use 3%. Look up top. Let me make this bigger. SPY yield of 3%. That's at 3%. And I'm going to assume it's at 35%. So I'm going to do equal 3% times 35%. So I'm 35% in debt, which is 1%, but I get a tax deduction. So if I assume Coca-Cola is in like the 30% rate, the 30% tax rate, then I'm only really paying 70% of that 1%. So I put the 1% times 0.7, or the reciprocal of 30% tax rate. That's right. Think about your mortgage. If you're in the 30% bracket, you pay your mortgage, effectively you're deducting 30%. We went over this in the past. I'm just doing this as a review. So that's my rate on my bonds, my weighted average weight. If I make it a percentage, it makes it a little clearer to see. It's about 0.735%. And then to do the capital asset pricing model, remember how that works. It's the risk-free rate, which is 2.5%, plus the beta, which is 0.6, times the rate of return on the market, B5, minus the risk-free rate. That's going to give us, hopefully that gives us, yes, that's Coca-Cola's equity rate, required rate of return. It's again, before the risk-free rate plus the beta 0.6 times the difference between the market risk premium, the difference between what the market gives you 5% and what the risk-free rate is. So you get 2.5% market risk premium times 0.6 plus the risk-free rate of 2.5%, which is the 10-year treasury, by the way. We use the 10-year treasury to get the risk-free rate. 10-year treasury, which is right here. That's generally the risk-free rate. Now, they actually, it's 1.5%, but I'm giving you more general numbers. Okay, just for illustrative purposes. And we know that they're approximately, I should really have moved this here. Just let's leave it alone. So we know that we're approximately 65% financed in equity. So we're going to take that 4% multiplied by 65%. That's my equity, which is, let's make it in percentages, be consistent. So my equity rate of return is going to be, my equity going to be 2.6%. And the 35% I finance the debt is going to be 0.74%. I sum these up. I'm going to get a rate of return of weighted average cost of capital of 3.34%. And that's where Coca-Cola, that's their discount rate, which is so low, it allows them to consider deals that other companies can't consider. Now, they have to consider deals that are in their corporate charter. It's got to be soft drinks or, food. I mean, they can't start a biotech company because it would change. Investors would react to that. They'd say, well, Coca-Cola doesn't do biotech. Why are they doing that all of a sudden? And the next thing you know, their debt ratings would go down and, their equity required rate of return would go up. The stock would be much more volatile. But if they stay in the business of what they do, we can assume that a number like that is where they have to source capital. It's 3.34%. So this is a good view of how you find weighted average cost of capital. It's again a further review from our previous classes, so you know where we stand. Any questions? Any questions? I have a student here today, so I'm thrilled about that. David, any questions?
Yes, I do have one quick question. Why did you use, for the first part of the weighted average cost of capital, why did you not use the 2.5 risk-free rate %?
Good question. Because Coca-Cola doesn't pay the risk-free rate. The government pays the risk-free rate. Coca-Cola is going to pay a slight premium because they're not the government. They're very safe, but they're going to pay a higher rate. Just like you would pay a higher rate or I would pay a higher rate because my credit ratings, even if they're good, they're not as good as the government. So the government is the lowest, pays the lowest rate because it's the government and they have the military and we have the Federal Reserve and we're the United States and it's a wonderful economy, thank God. But other companies are going to pay a little bit more. Everybody's going to pay a little more than the U.S. government on a relative basis. Does that make sense?
Okay, yes.
Okay, great. And then you got the tax deduction I factored in. Any other questions, Dave?
Not for now.
Okay, great. So let's move on from there. And now that we covered that, let's move on. And this is really what we want to learn today, which is how do we determine capital budgeting, right? And the other part of this chapter, and again, we only have an hour here, is cash flows, which we've gone over a number of times. So what I'm going to ask you to do is when you're studying at home to go over this chapter, which is chapter 12, I believe it's chapter 12, and it goes over depreciation, the stuff we went over in the beginning, right? The stuff we went over in the beginning, how we determine a project's cash flows. Okay, I'm going to leave that up there for a minute. Again, if you want a refresher, then go to my Accounting Academy or my Introduction of Financial Statements. And that's going to take you through how you determine cash flows. And and then of course, if you need it, let me know. And I think I know I put it in the shell, but we have our interactive spreadsheet. So again, this all builds up to capital budgeting. All builds up to capital budgeting. All right, so going back. So what is capital budgeting? So it's the decision whether we do a project or not. Disney decides to invest into $17.5 million to build Disneyland in California. It is an example of a major capital budgeting decision. How does it impact Disney? Firm's management identifies investment opportunities, and then they decide whether it creates value for the company. There are different types of capital investments. There are capital investments that enhance revenue. There are capital investments like buying new machinery that reduce costs. So we got revenue enhancing like Disneyland. We got cost reduction like buying new machinery, buying new technology. Reduces your cost. You make an investment, but it reduces your cost. So think about those two different ways we make investments. And the third is mandatory investments, or the kind of investments that the government would mandate. For instance, if you're an automaker, you might have to put in various safety protocols. And by safe, you might, before you can start making the car, you have to invest money in things that allow you to come up to speed, or that you don't pollute the environment, or any of those things. Okay. And to determine it, we use a couple of different methodologies. And again, I can't stress this enough. I have 5 videos in the discussion that go through each one, but I'm going to go over them briefly today. So you got net present value, equivalent annual cost, internal rate of return, payback period. So let's start with net present value, which is the gold standard of capital budget. It's what we do is, and it's the gold standard because you'll see as you learn about the other capital budgeting decisions, they all have some sort of relative flaws, not all of them, but the net present value really doesn't have any flaws. It's the difference between the present value of cash flows and you discount your your cash flows after you've done all your accounting. You discount, and where do I find that number? How do I know my cash flows? Well, then you got to do an extensive job and put together the project's free cash flows, which is a job, right? You have to sit and you have to go through my accounting videos, but you're putting together for your business, for your entire business, and for a project, all of your revenues, less the taxes, age of depreciation expense. You got to count for everything, working capital. Once you've done all of that, you're going to get a net operating profit after taxes, and that's not an easy job. It's that little vignette there that I show you, that little summary is a lot more intense, but you've got to do all this accounting and maybe do a 3-year projection. But we've gone over that. We've gone over a lot of that. You should have learned some of this in accounting, but that's how you get your cash flows. And again, you'll find that in my other accounting. You'll find that in my other videos. But today's about capital budgeting. So we're at the end of the class. So net present value basically does this. It takes your weighted average cost of capital and it discounts your cash flows. And that's how I know what the value of the project should be worth today. So once again, I take all my cash flows, and this would be your equation, and I discount it by a discount. So Sabre Electronics provides specialty manufacturing. They make an initial outlay of $3 million. So that's what the project costs. They have a very simple example here. And management estimates that the firm might generate cash flows for years 1 through 5, and there's your cash flows, 500, 750, which looks like a typical project. And they're going to use a 20% discount rate. Where did they get that discount rate? We know how they do it now. It's their weighted average cost of capital. So Sabre knows where they get debt, where they're sourcing equity, what their partners expect, and they feel that if they can justify a 20% discount rate, obviously a higher discount rate is going to lower your present value of cash flows. Lower discount rate, higher value. That's what it looks like. And one thing I urge you to do when you're learning this stuff, always write it out. Write out a cash flow statement. Write out a time series. And that helps you to visualize it. So we have this time series where we lay out $3 million in time 0, and then we have these positive cash flows as we move along. Take a look at that. And is it a good investment opportunity? We're not sure, right? We have to use a formula, which is taking these cash flows and dividing by the discount rate. So when we do it, we're going to take the initial cash flow, and then we're going to add each cash flow divided by the formula for present value, which is 1.2, right? 0.2 being 20%. You have to put a 1 in it. In the first year, you don't have to raise it to any value. But in the second year, you have to raise it to a value so it accounts for 2 years out. Discounts at 2 years out. You're dividing by. If you multiply it, you get the future value. You're now dividing. Again, we went through this in time value of money. So we're taking our second cash flow and dividing by 1 plus your discount, your discount rate raised to the power of the year. If it was a 6-month value, then I'd have to half the discount rate and double the exponent. And then add the third year, add the fourth year, add the fifth year. Divide. And notice that when I divide by these factors, I get smaller numbers. 500,000 equals 416, 750,000 equals 520, 1.5 million equals 868, so on and so forth. My project is worth 573,817. Now, how do I do that on Excel? Which is what I want to show you. So let's go back to our initial problem. Bear with me. So we're going to do, here's how you do it on an Excel spreadsheet. Really neat how they do it. And that's how you want to do it, right? And this is where I want to spend my most time because this is like I say, the gold standard. So we're going to have a minus 3 million when we start, right? That's 3 million. And then we're going to have cash flows of 500,000, 750,000. 500,000, 750,000. $1.5 million, 2 million, and 2 million. Is that right? 1 million, 2 million, and 2 million. Double check that. Yeah. 1.5 million, 2 million, and 2 million. Nope. That wrong. You with me? So those are your positive cash flows. So this is your outlay. I'll call it OL. And this is year 1, year 2, year 3, year 4, year. How do we get net present value? Simple. Go to formulas, financial, NPV. Oh, I've missed one thing. Sorry. Let's start first. And here's your discount rate, which is your weighted average cost of capital. We're going to call it WACC. And it's 0.2. Percentage is to make it a little more elegant. Now we're going to go here. Our formulas I could do recently used. And my rate's going to be 20%. And my values are going to be all my positive numbers, not my outlay. Remember that. And I'm going to come up with 3,573,816.87, which is the present value of the 5 cash flows. So what's the value of this deal? Hopefully this is a good illustration and you could use it. It's going to equal this minus my outlay. Oh, something wrong there. Oh, I got to add it because I made it a negative. 573,816. Let's see if I'm right, which I better be. Professor, right? Yeah. And there you go. 573,817. Which I think if you round, you're going to get 870. There you go. Notice if my weighted average cost of capital becomes like Coca-Cola's, which is 3.34%, watch what happens. What do you expect to have happen? What do you expect, Dave?
to go down.
The value of the deal goes up to 3.6 million.
Oh,
I'm discounting by a much lower rate. But I did 0.34%, I'm sorry. 3.34%. Notice how it goes up. This company is much riskier, so it lowers its present value. Notice your value goes down. So it's a function of where you're sourcing capital. And then, of course, it's a function of cash flows and outlook. And those are the things that determine whether a deal is viable. So hopefully that's a help to you. That is a help to you. And that illustrates how you look at a deal. Get pretty. A blue guy. There you go. We made a little spreadsheet for you. What I'll do is I'll insert this spreadsheet in the discussion today. Just to help you guys out a little bit. Yeah. So you can play with it. That's the gold standard. And the reason why it's the gold standard is there's really not a lot of flaws in the logic of it. Everything fits in a net present value project. You know, and if you have a couple of tricks, if you have different discount rates, because sometimes discount rates change. Maybe you're doing a deal that's more sophisticated, and I urge you to do more sophisticated work. The 20% doesn't last forever. Maybe 20% only applies for the first 2 years, but you expect your company to do much better, and you assume a lower weighted average cost of capital. And maybe it drops to 10% in years 3 to 5, because you know your company is growing and you're going to make that assumption, and your investors agree with that assumption. Well, then you would work out different numbers for years 3 to 5 and just do it on your own. You know, you do 5 different discounts. So all this stuff on a spreadsheet could be the beauty of a spreadsheet is I could change my cash flows for different scenarios. Generally speaking, I probably want to have 3 scenarios on cash flow: a recession, normal market, and a boom market. We see how fast things could change. All of a sudden in the last year, housing prices have soared. If you're in the housing business, that things have changed for you, obviously. If you have anything to do with housing, you know, things change. So I may want to run the numbers up a number of ways, which I can do with a spreadsheet, and look at all my different values and effectively come up with a standard deviation of values. And I'm able to show my investors that. And they love that stuff. They should love that stuff. Any questions?
No.
Good. All right, excellent. So this is a good example of the gold standard in net present value. I'm going to get into a minute why we don't always use the gold standard. Okay, so we have different kinds of projects. That's another thing we want to cover. A company like Coca-Cola or let's use Coca-Cola or IBM. They're huge companies. Apple, they have unlimited sources of funds, literally. I mean, nothing's unlimited. We know that in economics we have scarcity, but they have a lot of capital. So they really never have to say, I'm not going to do one deal, I have to do another. If something makes sense on a management basis, and again, this gets into much deeper finance, the people running the company agree that it's a good deal, the numbers add up, all that stuff, it's consistent with the direction and the mission of the firm, they're going to do the deal because capital is there for them. And if it doesn't add up, they're not going to do the deal. But with smaller companies, even if everything lines up, there's a finite amount of capital. They can only borrow so much. They can only sell so much equity. The markets just won't accept it. They won't buy the equity after a while. You know, there's a limit to how much money they could raise. In that case, they have to rank their investments. So sometimes we have unlimited amounts of capital where we can do as much as we want. Sometimes we have limited amounts of capital, in which case we have to choose the investments that make the most sense. And that becomes mutually exclusive. So how do I do that? I have to look at the first thing is I look at the net present value, and I can look at substitutes or I can look at firm constraints. If I got substitutes, I might choose one over the other. And I've got to look at my constraints. Management time, financial capital, which I just talked about. And then if I have the mutually exclusive or I have firm constraints, I choose the one with the higher NPV. If I don't have the firm constraints, then I calculate the equivalent annual cost. And what is that? Why do I need to do that? Because not every deal has the same life, right? So I have to make them equal when I make my decision. All right, I got all the money in the world, but not, some deals might take 10 years for fruition, some might be done in 3. I have to treat them as such, so this way I know I compare apples to apples, because a 3-year deal is going to be different than a 10-year deal. We know that time value of money should account for most of that. So how do I make that work in a financial sense? How do I put that time value of money in a financial sense? So what I do is I've got a machine. Now this is a cost reduction deal that costs me $50,000 and requires a payment of $6,000 a year of maintenance that and lasts for 6 years. So I got to, once again, I have to lay out 50 and I got a payment of 6 for 6 years. I have a 9% weighted average cost of capital, and I won't have a salvage value, which if you go through the cash flow analysis, you should have a salvage value, right? Some machineries will last me for 10 years and then I can sell it and stay, there are people out there who do refurbishing, they'll buy it, they'll fix it, they'll sell it to somebody. So I'll get some money back at the end, less my taxes and everything else. And I intend to replace the machine with no cost. So if they were cost and they were salvage values, I have to adjust for that. But we want to make this ceteris paribus, which means all things being equal, so we just focus on the problem. So I have a machine that costs $50,000. I've got payments of $6,000. I have operating expenses that last for 6 years. So that should make sense to everybody. And that's what it looks like. Again, I always urge you to draw a timeline. Lay out the 50, and then you lay out 6. And you have the discount rate of 9%. So what's my equivalent average capital? I compute the NPV, and then I compute the EAC. I do the same thing I just did for you, so I'm not going to repeat it. You could do this one at home. And the keyword this week is present value. Keyword this week is present value. The keyword this week is present value. So I do these cash flows and I discount them, just like I did before. And since it's if steady cash flow, I can use this. I don't have to do each one. I can use this formula, 1 minus 1 divided by. And I could divide by that. All I'm doing is I'm coming up with a factor of an annuity. That's the factor of an annuity. Why is it an annuity? Because the cash flow doesn't change. So I could use that equation. Or even simpler, I could just put it into an Excel spreadsheet and use the net present value function. It stays the same. So rather than having to do each one, I could do it this way. 1 minus 1 divided by 1.09 divided by to the 6th power divided overall by 0.06. That gives me this 4.4859, which is the annuity discount factor for 6 years at 9%. So I take my 50,000 I laid out in the beginning plus the discount on the 6,000 over 6 years, and I'm going to get a cost of 76,915. Then I divide that by the annuity factor, and I get my equivalent annual cost. My equivalent annual cost, which is 17,145, which tells me annually what this whole thing looks like. And by doing that, I can compare a 3-year deal with a 6-year deal. And you would notice if you do the math at home, it's going to compare apples to apples. And now I can make a 3-year deal and a 6-year deal, and I can look at them on an equal basis. So I just did a little more math to make sure that I understood my equivalent annual cost. And that's how you would do it in a financial calculator. And you could do it on an Excel spreadsheet. That's it. Most textbooks won't even get into this. Most textbooks would stop at net present value. So I kind of appreciate that they went the next step here and showed you how to look at different deals. Obviously, these are very, I don't want to call them simple because I'm sure you're not saying, hey, this doesn't look simple, professor. But they allow you to understand the basics. Like if I was teaching you basketball, right? I'm a basketball guy. I played basketball as a kid. I'm teaching you free throws. I'm teaching you rebounding. I'm teaching you dribbling. I'm teaching you how to set a pick. Obviously, the game, and as the game gets more sophisticated, these get more difficult to analyze. but you have to do all the work. It requires a lot of work, but at least now you know the methodologies. Any questions?
No.
Good. Okay, let's go through the list. So now we've done the big ones. This is one that I kind of like. It's just a spin. That's all it is, profitability index. And all the profit, I could be quick with this one. All the profitability index is we taking the net present value and we're dividing it by the initial outlay. So it's just one more piece of math, right? Going back to our example, which I'm going to post, we're taking this value and dividing it by the initial outlay. And what that does is it gives me an index. And the index is a simpler way to look at my net present value. Because why? Most managers who talk to their CFOs, they really don't want to get into net present value. Why? I mean, it depends on the company, obviously. If you have people in the C-suite that are really finance people, yeah, they're going to make some sense of it. They're going to know what you're saying. And that's not to say that people running companies don't understand finance. They do. But when I start getting into 500,000, 700,000, 24,000, a million, three, it's not as elegant as saying this returns 13%. This deal returns as a profitability index better than the other. Certainly percentages make a lot of sense to people. I'm talking to you about buying McDonald's. I could say, well, you buy McDonald's and there's this much revenue in this area and this is the cost and you're going to come out with these many dollars every week. Start to like people glaze over. But if I say you buy a McDonald's, make your initial investment, work the McDonald's, you should get a 13% rate of return on your money. Well, now I can compare it to anything I do. Bigger McDonald's, it's still going to be 13%. So it kind of makes everything relative. Okay, makes everything relative. So in the profitability index, back, when it's less than one, it's not a good investment. When it's greater than one, it is a good investment. So we have a company that has a 50,000 outlay and they expect to provide cash savings over the next 6 years. So again, cost saving. And there's the cost saving, 50,000, and we expect to save this money by investing this. This is a cost saving opportunity. A little different than the last one, because now we have positive numbers. But I lay out the 50 and I expect to save this every year. So should I make that investment? I have a discounted rate of return of 10%. Let's see if I can make this work. Sometimes you could just paste these in. I think that's going to be the case. Okay, so we'll just use this. And I just did a net present value analysis. So I look at my cash flows over the year, which is then divided by 1.09. So these are my cash flows divided by 9%, just like we did in net present value. And I come up with my net present value of expected cash flows. Now, if you go ahead and put these numbers, and this spread, this particular PowerPoint won't allow me to do it. Some PowerPoints allow you to copy and paste. You actually get the numbers in the spreadsheet. I can't do it. So if you put these numbers, and again, do this at home. If you took these numbers and plugged them into a spreadsheet that looks like mine, and discounted by 9%, because 9% stays the same every year, you're going to come up with a number that looks like 53,000. It is going to be 53,681.72. And I'm going to divide it by initial cash outlay, which is 50,000, and I got a profitability index of 1.073, which means I'll do it. It's greater than 1. All I'm saying is my present value of cash flows is better than by 1.073 my outlay. And it's a way for me to explain to my superiors or the people I report to or my investors what this deal should look like. And here I would take this divided by my outlay. Bear with me. I'm sorry, I did that one. Sorry, to the wrong one. Take the net present value divided by my outlay. I'm going to want to make this positive number, so I'm gonna put a negative there. It's 1.1. Now you express that in percent. If I express it in a number, you'll get the index. 1.1. There's your profitability index. So you can take that and use that also. Make that a different color. There's your profitability. Notice that if I use a lower weighted average cost of capital, like say 10%, these things are so tricky, you gotta be so careful. Let's try 0.10%. My profitability index goes up because my weighted average cost of capital goes down. And if I were to raise these numbers or lower my outlay, let's say I only have to lay out $1.5 million. Look at what it does to my value and my present. So those are all different variables, right? Algebra that affect my value and my profitability. Any questions? Any questions?
No, I got this.
Excellent. And it's a good way. And again, why do we use it? Because it's an easy way for me to explain it to my investors. I don't have to get into all these numbers. Now, obviously, they're not just going to throw money at me. I might have to give them a spreadsheet. I might have to give them a book, you know, what we call a deck that gives them all the information on the deal and all the cash flows. They're going to require that. Don't get me wrong. And let's go into the real world for a minute, because one thing I really don't like about, you know, way things get taught sometimes, and I'm very, you know, I did this for 35 years. So one of the things I hope bring to the table is my practical knowledge. So in the academic world, we would stop here. But in the real world, I got to apply this stuff in the real world. How do I do it, Professor? How do I transfer this into the real world? Well, you know, you would put together a book, you know, for your investors or for your managers, depending on what you're doing here. If you're raising money for your company or for your investors. If you're working as an executive at a company like Coca-Cola, you would have to put something together, a spreadsheet or a PowerPoint and a book. When I call it a book, you know, a flip book, for your managers, for the people who approve your deal, for the senior staff. And you would put together an introduction on what you want to do. Then you would start to talk about the variances of cash flows. Then you would show them the different ways that you would look at how the cash flow should go, different discount rates. And then ultimately you'd give them numbers like a net present value and profitability index. So now they could, but if you just are introducing this deal, you would do a 5 or 6 or 7, but don't forget, these guys don't have, or these women don't have hours and hours. They want to know, they're busy people and they're looking at a lot of deals. So you want to sit there and come up with a flip sheet that where you can, in 7 or 10 PowerPoints, summarizes what you're talking about. This is my rate of return. This is my profitability index. This is the kind of deal I'm looking at. And that's why when you hear about these guys working at investment banks and they do all kinds of hours, well, someone's got to put these spreadsheets together. Ultimately, the managers know where they want to come out or what the rates of return should be, but someone's doing the work. Okay, finally, internal rate of return is we're setting the deal to 0. And we're setting it to 0. So it's the amount of rate of return that allows the initial cash flow, the amount of initial cash flow less your positive cash flows to equal 0. And if I do that mathematically, I know what my rate of return is. It's just giving me the rate of return on an investment. So we accept the project if the IRR is greater than the required rate of return. We reject it otherwise. So how would I do it? Well, they give you one example here, but I'm going to do it with our example, because we're going to run out of time eventually. And what I have to do is I'm setting it to 0. So I go to formulas, go to financial, go to IRR, and I just take all these values in, my positive and my negative values. I say, okay, there it is, 27%. 27% is my internal rate of return, which is greater than 20%, which if you do the math, it'll equal, well, that's why it's a positive value, you know. It's going to be 27% better than what I'm laying out. That's my internal rate of return. Just do this again for you. I'll put it here. So I go back to formulas. I'm going to use recently used now because it's there. and I just look at my outlay and all my positives. That is my IRR. Getting that little warning sign because it's always a guesstimate, is what the system will, and that's all mathematics. I'm not going to get into it now. But there's my IRR. And this is, and I'm going to get into a minute why there's a problem with IRR from time to time. It's almost as good as, and in some ways even better than net present value. This is easy to explain. But there are issues with the IRR, and that's why we have to be very careful with it. Get into that. So here they give you an example that you could work at home again. You're laying out 10,000 and you're making this amount of money, 1,000 for the first 2 years, 3,000 and 6,000. When you plug it into a spreadsheet, okay, at different discount rates, they did it by hand. They looked at all these different discount rates until they come up with one that equals 0. That would be like if you took this spreadsheet and you just kept working on different discounts. Instead of having this function, you just kept changing your discount rates until you had 0. So let's say I kept guessing 23, 24, and eventually I put in 27%. Pretty close. I'm almost at 0. And that's my return rate of return. Let's just expand it so I can give you the exact number. Actually, 26.54%. If I put in 0.2654%, $303. Almost at 0 value. Let's go even further. Let's play with this a little more because fun with numbers, right? Let's use 2.265439. Now, if I put that one in, I'm almost at 0. So I could tell my investors that that's the rate of return. The people have to approve my deal. And that's all IRR is. It's just the rate of return on the deal. But we know, going back to the beginning of the deal, that this was a 20% rate of return. And obviously, because the internal rate of return is higher, it's a deal I want to do. So I can confirm it in many ways, but it's all the same there. Any questions, Dave? Appreciate having you here, Dave, by the way. Now, what is the prominent IRR? Here it is. They give you another example, which is a copier that has uneven cash flows, and that's the problem. This particular copier, it starts out, you lay out money, you make money in the first year, and then it has to, they forget what the story is. They, in year 2, you have to spend a lot of money on this particular machine. Who knows? They just made that up. It could be anything. It's just not even cash flows. So the first year you kind of make money, and then they charge you a big charge in the second year. I guess if you keep the machine, you pay a big charge. The problem is you have positive and negative cash flows, which in most deals, all the cash flows continue on positive. Why would you do the deal otherwise? Right? You want to see positive cash flows. So then you make a decision. Here's the issue, and I'm going to be simple. Whenever you have a deal that has uneven cash flows, which means you have positives and negatives, the IRR will give you a number of different answers, and that's just mathematics because of the different discount rates. So it's not going to be as accurate, and I'm going to leave it at that. If you want to spend time, that could be its own class. We can go to, it's more a mathematical class, but you're going to get all these different net present values, and that's going to throw off your decision-making process. And you notice that they kind of go over it. So if you want, I will also add these spreadsheet, well, you have the text, but I'll put these, I will put these PowerPoints in this week's work since it summarizes everything. And notice, depending on the different cash flows, it's the same deal and I'm getting different returns because of the negative number. I'm going to leave it at that. We could spend, it's 11:58, we're here an hour now, and I know we want to keep it to that, but I could go through this all day long, but that's the bottom line. The only problem with IRR is when you have a series of uneven cash flows, meaning negatives and positives. As long as they're all one way, as long as they're all positives, you could use IRR. And it's very good because it's easy to understand, easy to explain. One of the ways you can solve the problem I just talked about is modified internal rate of return. I don't like it. What you do is this is negative, positive, negative. You kind of combine the negatives and account for the present value, and that will make it work. It's a device to solve for it. I don't like it. I think it's like banging a square peg into a round hole, and just go with the net present value at that point. That's what I would prefer. But if you had to do it and wherever you're working, they demand that you come up with an IRR, and this is your problem, then you would have to go back to your textbook, look up modified internal rate of return, combine the two negatives, and then discount them. And then you got numbers you could work with. Notice then they become a negative and a positive, and you can make it work. But you have to discount this second negative and add it to the year zero. And again, I'm not in love with it because it doesn't give you. Why I don't like it is that it's not really what happened. I have a negative, I have a positive, I have a negative. I have to really. I mean, you could do it. I think you'll be fine mathematically, but I think you got to be very clear to the people you're explaining to that you've used this method. That you had an outlay, you had a positive, you have an outlet. Because what's going to happen if they just assume, oh, it's a great deal, they're going to, and you don't explain it, they're going to assume that you're going to have cash flows every year. And when year two rolls around, you've got a loss, and then you got taxes involved and everything else, you're going to get pushback. I mean, you should expect pushback because you're not being accurate. So I think you got to be very clear with whoever you're explaining this to that you modify these numbers and that it's actually a negative outlay, a positive outlay, and a negative outlay. And that you combine the negatives to make it work on an internal rate of return. That's your issue. Okay. Finally, the most simple is the payback period, and I'm going to wrap it up here. You basically pick a time frame, and businesses work like this all the time. And by the way, there's a summary here, so I'm going to add this. So the payback period basically says, when do I break even on this deal? And if it's and I have a rule of thumb in my company. So say for instance, and let's look at the payback period. I laid out 3 million, right? So so when do I make back my 3 million? Well, let's just add them up. Adding that in year two, I'm not breaking even yet. Right? I'm up to 1,250,000. Then I take that plus that. I'm up to, I'm sorry. I'm up to 2 million. Is that right? Got 1,250,000. Then I made 1,500,000. Add to that 1,250,000. And I'm up to 2,750,000. I will break even somewhere in the first quarter of year four. Right? Because I'm up to 2,750,000. I put out 3 million. Somewhere in year four, I'm going to break even, and that's the payback period. And what does that tell me? Well, if I have to break even in 3 years, I wouldn't do the deal because I'm not going to break even to year four. And if my rule of thumb is 3 years, I'm going to stop there. If my rule of thumb is 4 years, I'll do the deal because somewhere in year four I break even. In the first quarter of year four, because I'm going to make 2 million that year. Somewhere in there, I'm going to pass the 3 million. Right? So that's my payback period. For that payback. And what's the good news about the payback period? It's simple to understand. It's the way most people will do it. Remember, the business has been done forever, way before we had all this fancy math and calculators. So I'm thinking back to my in-laws, who were great people. They had a chain of delicatessens or Italian superettes in Staten Island, and basically told it to my mother-in-law, may she rest in peace. She would say, I have to make 30% on every deal. Whatever I carry, whether it's hero sandwiches or beer or prepared foods, I can make 30% generally. I'm doing well. And they did well. And that was a good rule of thumb. And that's a rule of thumb that comes from years and years of running the business and talking to other owners of businesses. So payback period makes sense because it's a good rule of thumb. Like we have rules of thumb all the time. I'm sure when you cook, when you have recipes, you don't look at the recipe constantly. I mean, again, I'll go back to, I'm Italian, when I watch my wife or my family, people in my background made sauce, right? We always make a tomato sauce and pasta. They didn't take out a recipe. After a while, they had rules of thumb. So it's something you're doing over and over again. A rule of thumb works, and payback period is a good rule of thumb. I know of a person that I've talked to in the past. I lived near the Jersey Shore, who had been involved in a lot of the seasonal Jersey Shore businesses, things that you run during the summer. And this person really knew what they were talking about. They had been in that business forever, and we were friendly. And they said, you know what, Eddie? If I don't break even by July 4th, it's a bad year. Now, is that a hard and fast rule? Is that high finance? Is that present value at discount? No. But I can assure you that he knew what he was talking about. He needed to break even by July 4th. He said, if I break even by July 4th, I know I'm having a good year. But if I'm not breaking even by Independence Day, it's going to be a lousy summer. And that's just the rule of thumb. So the problem with a payback period is, in a case like this is a good deal. But if I have a 3-year payback, I'm not going to do it. So I'm not accounting for I'm not accounting for increased cash flows in later years. That's the problem. The benefit is it's simple, it works, and if you know your business and it's a rule of thumb, then go ahead and use it. What's my advice? Use a combination. Do it all. Run them all. Because you're dedicating a lot of money to this stuff. So run them all and see what makes most sense. And I'm going to wrap it up here. It's been great teaching you guys. Present value is the key word. You've been terrific. Get your work done. Let's call it a class, and I'll get the grades done as soon as possible.
Thanks a lot, Professor, and thanks for your YouTube videos.
Thank you, David, and thank you for attending. It was a real help to me today.
Good luck. Thank you.
Thank you.